The world watched as Russia invaded Ukraine, a move that sent shockwaves through the global order. Beyond the human toll, the conflict triggered a cascade of economic consequences, most notably the sanctions imposed on Russia by the West. While intended to cripple the Russian economy, these sanctions have had a more complex impact. In the short term, Russia has witnessed a degree of economic resilience, with its GDP experiencing modest growth. However, this apparent stability masks deeper vulnerabilities. Russia's reliance on energy exports, particularly to Europe, has been challenged as nations seek alternative sources. Sanctions have disrupted supply chains, making it more costly and difficult for Russia to engage in international trade. The ruble, once a stable currency, has faced significant pressure, and foreign investment in Russia has dwindled. These factors paint a picture of an economy walking a tightrope. While Russia may have weathered the initial storm, the long-term economic outlook remains uncertain. The sanctions have exposed structural weaknesses in the Russian economy, particularly its dependence on natural resources and a lack of diversification. Furthermore, the Kremlin's efforts to mitigate the impact of sanctions, such as increasing state control over the economy, could stifle innovation and long-term growth. The economic war being waged against Russia through sanctions is unprecedented in its scope and severity. The outcome of this economic standoff remains to be seen, but one thing is clear: the Russian economy will emerge from this conflict forever changed. The conflict in Ukraine has ignited an energy crisis that's rippling across the globe. Russia, a major energy exporter, has seen its supply chains disrupted by sanctions and geopolitical tensions. This has led to a surge in energy prices, with oil, natural gas and coal all hitting multi-year highs. This energy shock is exacerbating inflationary pressures that were already building in many economies. For consumers, the pain is being felt at the gas pump and in their utility bills. Businesses are grappling with higher input costs, which are being passed on to consumers in the form of higher prices. Central banks are under pressure to raise interest rates to tame inflation, but doing so too aggressively risks tipping economies into recession. The global nature of this energy crisis is what makes it particularly worrisome. Emerging markets and developing economies, many of which are heavily reliant on energy imports, are being hit particularly hard. The surge in energy prices is pushing up the cost of food and transportation, exacerbating poverty and inequality. The International Energy Agency has warned that the world is facing the biggest energy crisis in decades, and that the situation could worsen if the conflict in Ukraine continues. Governments around the world are scrambling to find solutions, from releasing strategic oil reserves to investing in renewable energy sources. However, there are no easy fixes. The energy crisis is a stark reminder of the interconnectedness of the global economy and the potential for geopolitical conflicts to have far-reaching economic consequences. The current geopolitical landscape, marked by conflict and uncertainty, is forcing countries to rethink their economic strategies. The era of globalization, characterized by free trade and interconnected supply chains, is giving way to a new era of regionalization and economic blocs. Countries are seeking to reduce their dependence on potentially hostile nations by diversifying their trading partners and supply sources. This shift is evident in Europe's efforts to reduce its reliance on Russian energy. Germany, for example, is rapidly accelerating its transition to renewable energy and seeking alternative suppliers of natural gas. Similarly, the United States is bolstering its domestic energy production and strengthening ties with energy exporters in the Middle East. Beyond energy, there is a growing focus on securing critical supply chains for essential goods, such as semiconductors, pharmaceuticals, and rare earth minerals. Countries are increasingly looking to forge closer economic ties with like-minded partners who share their values and strategic interests. This is leading to the emergence of new trade agreements and economic alliances. For instance, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, a trade agreement among 11 Pacific Rim countries, is seen as a way to counter China's growing economic influence. The current geopolitical climate is reshaping the global economic order, leading to a more fragmented and regionalized world. This transformation presents both challenges and opportunities. While it may reduce economic efficiency in the short term, it could also lead to greater resilience and stability in the long run. Countries that adapt quickly to this new reality by diversifying their economies, securing critical supply chains, and building strong partnerships will be best positioned to thrive in the years ahead. For decades, the US dollar has reigned supreme as the world's reserve currency. It's the currency of choice for international trade, investment, and central bank reserves. However, the current geopolitical climate is raising questions about the dollar's long-term dominance. Sanctions imposed on Russia, which have limited its access to the US financial system, have highlighted the potential vulnerabilities of relying on a single currency. This has led some countries to explore alternative reserve currencies and payment systems. China, in particular, has been actively promoting the use of its currency, the yuan, in international trade and investment. The BRICS nations, Brazil, Russia, India, China, and South Africa, have also been discussing the possibility of creating a new global reserve currency. The motivation behind these efforts is multifaceted. Some countries see it as a way to reduce their dependence on the US dollar and the influence of US monetary policy. Others view it as a means to circumvent US sanctions and create a more multipolar financial system. The shift away from the US dollar is still in its early stages, and it's unlikely to happen overnight. The dollar benefits from deep and liquid financial markets, strong legal and institutional frameworks, and the trust it has built over decades. However, the current geopolitical climate is creating cracks in the dollar's armor. As the world becomes more fragmented and multipolar, it's conceivable that the dollar's dominance could gradually erode, paving the way for a more diversified global financial system. Section 5. BRICS' bold move. A new reserve currency on the horizon. The BRICS nations, a bloc of emerging economies comprising Brazil, Russia, India, China, and South Africa, have emerged as a powerful force in the global economy. These countries, which represent a significant portion of the world's population and GDP, have been increasingly vocal in their desire for a more multipolar world order, one where power is more evenly distributed. One manifestation of this ambition is the discussion surrounding the potential creation of a new global reserve currency backed by the BRICS nations. The rationale behind this idea is to challenge the dominance of the US dollar and create a more equitable and stable global financial system. Proponents argue that a new reserve currency would reduce the world's reliance on the US dollar, thereby mitigating the impact of US monetary policy on emerging economies. Furthermore, it would provide an alternative to the US-dominated SWIFT, Society for Worldwide Interbank Financial Telecommunication System, which has been used as a tool for imposing financial sanctions. The concept of a BRICS reserve currency is still in its infancy, and there are significant hurdles to overcome. Key questions remain unanswered, such as the composition of the currency basket, the governance structure of the system, and the willingness of other countries to adopt it. Skeptics argue that the BRICS nations lack the economic cohesion, political will, and institutional capacity to create a viable alternative to the US dollar. Despite the challenges, the fact that the BRICS nations are seriously considering this move underscores the shifting dynamics in the global financial system. The potential emergence of a new reserve currency, even if it takes years or even decades to materialize, could have profound implications for the future of global finance. Section 6. Safe havens. Amidst the storm, gold and commodities. In times of geopolitical turmoil and economic uncertainty, investors often seek refuge in safe haven assets. These are assets that are perceived as being less risky and more likely to retain their value during market downturns. Gold, a precious metal that has been a store of value for centuries, is often seen as the ultimate safe haven. Its price tends to rise during periods of heightened risk aversion as investors seek to preserve their capital. The current geopolitical climate, marked by conflict, inflation, and the spectre of recession, has led to a resurgence of interest in gold. Other commodities, such as oil, natural gas, and agricultural products, are also benefiting from the current environment. These commodities are essential inputs for many industries, and their prices tend to rise during periods of supply chain disruptions and geopolitical tensions. Investors are increasingly viewing commodities as a hedge against inflation, as their prices tend to move in tandem with rising consumer prices. The performance of gold and commodities in the coming months and years will depend on a multitude of factors, including the trajectory of inflation, the pace of global economic growth, and the severity of geopolitical risks. However, one thing is clear. In these uncertain times, investors are increasingly looking to tangible assets that have a proven track record of preserving value. Gold and commodities, with their historical significance and real-world utility, are likely to remain attractive safe havens for investors seeking to weather the storm. Section 7. Crypto on the front lines: digital currencies in conflict zones. The Russia-Ukraine conflict has brought to the forefront the role of cryptocurrencies in times of geopolitical instability. While cryptocurrencies were initially envisioned as a decentralized and censorship-resistant form of money, their use in conflict zones has revealed a more complex reality. On the one hand, cryptocurrencies have been used by individuals and organizations to circumvent capital controls and access funds that would otherwise be frozen or restricted. For example, there have been reports of Ukrainians using cryptocurrencies to receive donations from abroad and access essential goods and services. On the other hand, there are concerns that cryptocurrencies could be used by sanctioned individuals and entities to evade sanctions and launder money. Governments around the world are grappling with how to regulate cryptocurrencies in a way that mitigates these risks without stifling innovation. The use of cryptocurrencies in conflict zones is still evolving, and it remains to be seen what their long-term impact will be. However, one thing is clear: cryptocurrencies are adding a new dimension to geopolitical conflicts, and their role in these situations is likely to become increasingly prominent in the years ahead. Section 8. The digital future of money, CBDCs, and the evolution of banking. While cryptocurrencies grab headlines, central banks around the world are quietly working on their own digital currencies, known as central bank digital currencies, or CBDCs. Unlike cryptocurrencies, which are typically decentralized and operate outside the traditional financial system, CBDCs are digital versions of a country's fiat currency, issued and backed by the central bank. The motivation behind CBDCs is multifaceted. Central banks see them as a way to enhance the efficiency and security of payment systems, promote financial inclusion by providing access to digital financial services to the unbanked, and counter the rise of private digital currencies that could potentially undermine their monetary sovereignty. The development of CBDCs is still in its early stages, but it's rapidly gaining momentum. China is leading the charge, having already launched a pilot program for its digital yuan. Other major economies, including the United States, the Eurozone, and Japan, are exploring the feasibility of issuing their own CBDCs. The introduction of CBDCs is likely to have significant implications for the future of banking and finance. They could potentially disintermediate commercial banks, as individuals and businesses could hold accounts directly with the central bank. This could lead to a more efficient and competitive financial system, but it could also raise concerns about privacy and the role of commercial banks in the economy. The digitalization of money is well underway, and CBDCs are poised to play a transformative role in the evolution of banking and finance. Section 9. Navigating the new economic landscape: strategies for investors. The current geopolitical and economic environment is fraught with uncertainty, presenting both risks and opportunities for investors. Traditional investment strategies may need to be reassessed in light of these new realities. Diversification, always a cornerstone of prudent investing, is more important than ever. Investors should seek to diversify their portfolios across different asset classes, geographies, and sectors to mitigate risk. Given the current inflationary environment, investors may want to consider assets that have historically served as hedges against inflation, such as gold, commodities, and real estate. However, it's crucial to remember that past performance is not necessarily indicative of future results. The rise of alternative investments, such as cryptocurrencies, private equity, and venture capital, has provided investors with new avenues for diversification and potential growth. However, these investments often come with higher risks and may not be suitable for all investors. In these uncertain times, it's essential for investors to stay informed, seek professional advice, and carefully consider their investment objectives and risk tolerance before making any decisions. The current economic landscape may be challenging, but with careful planning and a long-term perspective, investors can navigate these turbulent waters and position themselves for success.